Good morning. Today I will be talking in slightly more detail about specialized investment funds because I received a number of queries. So I'm trying to give you a small comprehensive overview and also try to explain you how they are different from another category called mutual funds. So first of all, this is a new category called specialized investment funds by SEBI, which is basically for the niche high risk taking clients. So it's a high risk product. Minimum ticket size is rupees 10 lakhs. And they use various kind of derivative strategies to kind of offer a better proposition of downside protection. Though it's new in India, we don't know how they will play. There have been various AMCs which have launched these products of late, but the track record is very new, and it's always better to look and wait and see how they perform and then gradually do it. Now, one constraint was that in a typical mutual fund, let me give you a background. What happens is that the downside protection is limited because they are restricted to use derivatives only up to a certain level for purpose of pure hedging. So, and that too, the percentage is capped. I'm not sure by SEBI. You can't do beyond a certain percentage. So, if you're buying like a mutual fund buys typical stock, it's a long only portfolio. By long only, I means you buy and hold the stocks. Then what happens is if the price goes up, then the mutual fund is forced to have a lower NAV, sorry, higher NAV, or if it goes down, the NAV comes down. So if the mutual fund has hedged the portfolio, that means use some amount of derivative, then the portfolio is not as bad. Let's say the prices come down and there is some amount of hedging, then the NAV will be less impacted. To better that proposition and offer more flexibility, SEBI created this category called specialized investment funds, which have more leeway to use derivatives and even to use naked positions. Now, what I mean by naked position is that you do not need to have an underlying security and stock. You can still take a position and depending upon your view of the fund manager on the market, take a call. So that is more risky strategy, but then obviously the fund manager has to also have checks and balances. So that additional is 25% naked short position, which has been allowed maximum level by SEBI. So this is a broad gist of specialized investment funds. Now I will cover some more salient features to make you understand. So firstly, specialized investment funds, the ticket size is 10 lakhs. Number two, as I said, they offer higher flexibility compared to mutual funds, which are typically long only, that is buy and hold strategy, and bound by sectoral constraints. Here, compared to SIFs, the strategy is using more advanced features, derivatives, long short. That means you can have stocks and then have derivatives to kind of protect the positions accordingly. So, protecting the downside, the objective is to have a better risk adjusted experience. Of course, the risk is very high because derivatives is not for everybody. As SEBI keeps saying, that 90% of the people end up losing money in derivatives. So that is the caveat which I'm saying. Educated high net worth clients only need to look at such products, and that too, the objective is start very small piecemeal to see how it works for you. Because in India, the naked short 25% thing is very limited, and very few people, I'm not sure in India, are doing naked shots, not to my knowledge, at least from the Indian SIF space. Abroad, I'm not sure whether they're doing, and they may be doing. So risk levels are there, volatility may be also there, and while mutual funds offer daily redemption, SIFs may have restrictions of this thing. So you need to check with each specific thing. And why this category is also created is like typical PMSs or AIFs had higher ticket sizes, 50 lakhs, 1 crore. So some category in between for HNIs was created to kind of participate in this. Now, for the more people who want to understand SIFs, I will explain briefly. The derivative strategy used by SIFs are various. For example, one is called equity long short. So what happens is that equities are there simultaneously, derivatives take short positions. So it gives them benefit to allow both from market prices which are rising and falling. Then there's something called as covered call. These are derivative strategies, some of which may be used by funds. Covered call writing. So SIFs may use these strategies to generate additional some kind of a return on equity. The arbitrage is there, so they try to make a difference between the profit from cash price and the derivatives price in the market, like future price. So then they, as I said, lastly, 25% of naked short, that means unhedged derivative positions, are allowed maximum limit by SEBIs. So this is basically, to summarize, for the high net worth client, high risk client, kindly consult your own risk profile before entering into this and enter in a very small way. Thank you. This was just a small brief take. Now the disclaimer, this is not any kind of advice or for a promotion. I'm just trying to explain for educational purpose only. Kindly consult your experts and see your risk profile before taking any financial decisions. I will not be responsible for any loss on account of contents stated in this video. Thank you. Take care. Bye.